Hello, everyone. Today on the Final Bar, we'll do our normal Friday routine. We'll wrap the week by focusing on the Mindful Investor Live ChartList. We'll talk about how the big picture has changed from last Friday to this Friday. Holiday week, sort of not a shortened week, but leading up to the Memorial Day holiday, usually a little lighter volume, usually sort of flat to positive. No surprises this week, sort of following through as expected. The real question going into next week, do we get a follow through to the upside on the growth trade? Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com, coming to you this week only from sunny Naples, Florida. Thanks for joining us every weekday after the close as we focus on the action of the markets, how they've evolved over the course of the trading day, and trying to connect the flickering ticks of today, the short-term volatility, the short-term movements, to the long-term picture. I always remind clients and viewers and users, the most important thing I think you can do as an investor, as a technical analyst analyzing market dynamics, is to take a step back, not get too caught up in the short-term fluctuations. Even if you are a short-term trader, focus more on the long-term trends and how those are evolving. That's how you understand changes in phase, where something's going from bullish to bearish phase, and so forth. Interesting take today, a bit of a give back there going right into the close of the S&P coming off quite a bit, but overall sort of the normal holiday week action, very near all-time highs, closing above 4,200. Now, this week we're wrapping today. Next week we'll be taking Monday off for the market holiday, and then we have some fantastic guests through the course of the week. We have Dave Landry from DaveLandry.com on Wednesday the 2nd. Wednesday the 2nd. On Thursday the 3rd, we have Craig Johnson from Piper Sandler in Minneapolis. On Tuesday, we'll do our normal Monday routine, which is looking at the market from three directions: top down, bottom up, and sector rotation. And today, by the way, is the final day of our 5-week exploration of idea generation. This is part of our new series called Chart School, taking the best educational content from our website and surfacing it on StockCharts TV. Go to StockCharts TV/Chart School TV. If you missed any of them, you want to see who is featured, you can get to all of those videos on StockCharts TV on demand, also our YouTube channel. I'm going to continue on and wrap this week. I want to start off very briefly with a poll. I asked you recently on the StockCharts TV page, also through social media, is the next 25% move in Bitcoin higher or lower? And what's interesting is it was almost split 50-50. About 46% of you saying 25% higher, 54% of you saying 25% lower. Now, what's, of course, with Bitcoin, I probably should have made it 100% because the fluctuations are so dramatic. We might hit that over the weekend. We could hit a 25% move, if not in an hour, given the volatility that we've seen in the space. But the general implication was to see where people are leaning. I'm not surprised that, asked that question. It's sort of a 50-50 split. It is hard to get a read on Bitcoin. I do not blame you for that. When we look at the chart of Bitcoin here in a little bit, though, I will tell you that Fibonacci retracements, tools like that help you focus on key turning points or potential turning points, key support and resistance levels, can be really valuable during a security or during a price action that's more volatile than normal. So we'll take a look at that together, see if that helps us out. Let's look quickly at what happened today, and then we'll take a look at the long-term trends through our wrap the week segment. So as I mentioned, the S&P really gave back a lot just right at the end of the day. We'll sort of continue to process the closing ticks to see where we're at, but we're closing just above 4,200 now. It was up around 4,210, 4,215 for much of the afternoon. So a bit of a give back, but overall this week sort of fit the bill of what the week before Memorial Day sort of looks like. And in the last week, that's sort of what we've been talking about. It tends to be lighter volume, tends to be flat to positive. No huge movements tend to happen. It's about what we saw. I don't know if this week changed the game in any material way. And it's easy to get caught up in the short-term rally that you saw this week. And I'd caution against that. Remember, the S&P is bumping against all-time highs. We haven't punched through them yet. A lot of growth stocks, the ARK Innovation Fund, Tesla, others are still pretty far off their all-time highs, and arguably more in a downtrend if you look at the trend in the highs and the lows. So a lot to be a lot of performance to be played out before you can declare those sort of in all clear mode. Small caps and mid caps, by the way, essentially flat, but small caps the weakest of the bunch, which is an interesting change from leading up to today, where you saw small caps continuing to be in the leadership seat. Let's look at our wrap the week chart. This is what we usually look at on Fridays, just to look at how the week has evolved. We'll refresh it very quickly here. I don't have labels on here, but I'll indicate through the mouse. If you follow what I'm looking at, I'll show you where each thing played out. The S&P basically up 1.3% from last Friday on the 21st to where we closed today. Gold was almost exactly in line with that same return profile. And interesting, gold is often thought of as a safe haven. It is often thought of as an inflation hedge. So if there are inflation fears, gold should be doing well. Gold overall has been doing okay, right? It's been doing pretty well. A bit of a pullback here in the last week or two, but overall, the price structure, I would argue, is still very, very good, and with a number of materials charts as well. And so overall, holding in line with the market, favorable this week. What outperformed the S&P this week? We have the NASDAQ 100 here, the Qs up 2.1%. In purple, we have small caps up 2.6%. Continuing on, emerging markets up 3.2%. And the biggest gainer out of them all, crude oil up almost 4% this week. And what's interesting, if you look at the chart of crude oil, we're sort of testing that long-term resistance. If you look at the continuous contract, it's had an incredible run. It's sort of up at the upper end of that range, has not really followed through to the upside. And a lot of energy stocks have sort of pulled back after, pretty solid runs to the upside. The question on my mind going into next week, we mentioned gold outperforming stocks, we mentioned crude oil outperforming stocks, commodities as a whole in a pretty good trend, but have paused a bit. I'm wondering if next week, when we sort of get back to a normal pace, if you see a reassertion of leadership from areas like energy and materials. That's an open question for me, because I think a lot of people are expecting the growth trade to just storm back next week. I'm not sure that's going to happen. Underperforming the S&P this week, we have bond prices using the TLT up 0.6%. Finally, flat for the week, the dollar, and the dollar overall has been on the decline in the last couple of weeks. This is after a pretty meaningful bounce after a downtrend. So seeing it essentially flat, and the worst of all these assets we're looking at is notable. We add Bitcoin to the mix. I usually take the cryptos out just because it's so much more volatile that it tends to compress the range of the rest of these. Here's Bitcoin down 3.6% for the week. We're going to start with the chart of Bitcoin here very quickly, and then I want to jump in just because I know it's not represented in the Mindful Investor Live ChartList here. But when you're looking at the chart of Bitcoin, people have talked about when we bottomed out at 30,000, or when we bounced off of 30,000. I went on Bloomberg television this day, and I was asked, whether we were going to regain all-time highs. Essentially, was the question I think a lot of people were speculating on. Like, okay, the bottom is in, we've gotten in there, we ride it higher, and I just don't see it that way. The way I've created or analyzed this chart is using these shaded areas based loosely on some of the Fibonacci relationships. And this is a busy chart with a lot of lines. If you want to dig more into this, by the way, on my own YouTube channel called Market Misbehavior, I posted a video last week where we talked in particular about how we set up these levels, what the shaded areas really mean. But what I'm seeing, taking a step back on a Friday afternoon, is a chart that has transitioned from an accumulation phase to a distribution phase. I don't see anything but that. I don't see something that is clearly bottomed out and is bouncing higher. I see an asset that rotated lower, put in a lower high, put in a lower low. At that moment, when it breaks down through the first group of Fibonacci retracements after making a new swing high, a lower high and a new swing low, that tells me by definition we're in a downtrend, and I'm assuming the path of least resistance is over. You combine that now with the fact that we've bounced off another Fibonacci support level, also the lows from January. That's a pretty reasonable place for the price to bounce. We've now rallied up to the 200-day moving average, and now we're rotating back down. We're testing 3,600 or 36,000, excuse me, as we're recording this. So I see this as a breakdown of a key moving average, a bounce back higher to test it from below, and now starting to roll over a little bit. The RSI has gone from a bullish range down to a bearish range, right? In a bullish phase, the RSI tends to become overbought and bounce back and remain above 40. That's what you saw through, a 6-month to even more period here in the second half of 2020, early 2021. That has now all changed. You're becoming oversold when Bitcoin comes off. When it rallies up, you're testing resistance around 60. So all of those things together, I mean, my analysis of this would tell you that the path of least resistance is lower. I'm not seeing enough to tell me that any sort of bottom is in. I'm seeing that there is more distribution to be had until you get some sign of accumulation, a higher low, some sort of validation, a bullish divergence, some indication that that buyers are coming in and pushing it higher. And it's not just, you know, the dead cat bounce, which I would argue is what we're seeing more now with the chart of Bitcoin. Boy, I didn't mean to ramble on Bitcoin so much, but it's such a fascinating chart. And I'm struck by how many people, you know, very quickly, you know, have just talked about how there's clearly a lot of upside from here. And there may be over the long term. I have no doubt that, you know, the theory behind Bitcoin and blockchain and all that, I'm a huge believer in the long-term implications. But as a technical analyst, I'm looking at the trend, and the trend is down. All right, to complete our Wrap the Week segment, we're going to look at the Mindful Investor Live ChartList. To get to this chart list, if you've never done it before, go to the Articles tab on StockCharts. Go to my blog, which is called The Mindful Investor. There's a link right at the top to this chart list. You can look at these charts, save them to your own login, do whatever you like with them. First, we're going to look at the market trend model. Now, with the bit of the bounce, the bit of the rally, all of the action at the end of the day, our short-term model actually turned just back positive. It was just the tiniest, slightliest bit negative last week. It turned below zero last week, back up in the positive, and that's again given the strength of this week and the bounce. I totally understand that. The medium-term model remains negative, and that's sort of my main risk-on versus risk-off model. That's telling me to be skeptical of the market going materially higher from here, to think more about risk management than opportunistically looking for further upside. And that's pretty much how I would feel at this point. Again, I always am super skeptical of a holiday week, which tends to be lighter volume and moving higher anyway. So this was not unusual relative to the normal script. I'm much more concerned with next week and whether you get a reassertion of the downtrend and further confirm the resistance that we're in, or we break to new highs, at which point I'll tell you it's we're all in, moving to the upside. The long-term model obviously has been positive for quite a while. Looking at the daily chart, I mean, this is where we're at. We've rallied back up, and at this point, we've gone nowhere on a directional basis since the end of April, right? In 4 trading weeks, we've essentially remained in the 4,200 to 4,250 range. Now, that's with a 4.5% correction during or pullback within that trend. So granted, that's a 4.5% range, but overall, we really have stopped the uptrend. The uptrend has paused. And I would need to see us move above the 42.25, 42.30, really get above 42.50 to signal further upside, to signal a continuation of the uptrend. If and when we would pull back going into next week, I think this trend line, taking the low from October and the low from March and connecting it to the lows in May a couple times, I think is a very valid trend line. I think the fact that the 50-day moving average is right about at the same point, around 41.15 right now, I think is a perfect line in the sand to manage potential downside risk. As long as we remain above that, I think we're in very, very good shape, even with a pullback next week. But overall, again, the trend is positive until you start breaking these swing lows. We haven't done it, and the RSI bounced off of 40, which is sort of a classic bull market behavior. Getting a bit into breadth, and then we'll touch on sentiment briefly. You know, when I'm looking at the breadth measures, my high-level synopsis would be overall very constructive. Jeff Hughes yesterday from JWH Investment Partners did a great job of describing the breadth conditions overall, very, very supportive, and I have to agree with them. Today, this is actually based on Thursday's close. The small cap advanced decline line made a new all-time high. The NYSE common stock only advanced decline line made a new all-time high. I would not be surprised if large cap and mid caps would confirm that today after the close. We'll have to see, but overall, the fact that this is being led by the small caps, again, for me in the back of my brain is thinking that tends to be more financials and industrials and some of those other underrepresented sectors in large caps that are a little more widely represented in the small cap space. The fact that small caps are leading the way at this point speaks more to those cyclical parts of the market. All right, so we also can look at the new highs. You know, on an average day this week, about 5 or 6% of the S&P was making a new 52-week high, and that's good, I guess. But it's certainly nowhere near the level that you would normally see during a healthy bull market phase. If you are a believer in the raging bull market thesis, if you think stocks have a lot to go from here, you better be hoping that this line starts to go up and that you see more of a healthy amount, meaning 10, 15, 20+% of the S&P making new 52-week highs on a given day. We've not been there. We've been more in the 4 or 5, 6% range, and overall, that's kind of a market that's in a standstill. It's in a pause, which I would argue we have been. About 75% of the S&P, by the way, remain above their 50-day moving average. The S&P, of course, remains above it as well. If you would get a pullback, I would immediately bring up this chart. I don't look at it as much during a normal uptrend. I'm more concerned when we do pull back to see if we test the 50% level. It's worth noting we got nowhere near that, which for me, my initial reaction is we haven't had enough of a corrective pattern then. If we didn't get down to 50%, that's what usually happens during a garden variety pullback. We didn't get that far down. We talked about sentiment a little bit yesterday, so I don't want to talk too much about it, but AAII survey remaining sort of mildly bullish. The name exposure index bouncing back up about 25% to be around 68% right now. And that's not overextended. That's not euphoric. That's sort of a healthy bull market phase conditions. That's actually good. This will be our last chart here for the weekly wrap, but I just wanted to point out when you look at offense versus defense, one of my favorite charts is within consumer. Are we leaning into discretionary or staples? We pulled back to the low that we made in late March and have bounced off of that. So the fact that we have not broken down, to me, tells us it is not full on risk off yet. But if and when we would get a further pullback in the S&P, this is a chart I would bring up to see if investors are rotating more to the defensive side of the ledger. We need to take a quick commercial break. We'll be back with the final bar mailbag. We'll see you in a minute. Hello, everyone. Welcome back to the final bar. This is Dave Keller here at StockCharts.com. Thanks so much for joining us every weekday after the close as we focus on the key charts every single trading day. As a reminder, we love to hear from you. We'll be answering questions from the final bar mailbag here in a moment. We would love to hear from you and answer one of your questions in our next mailbag segment, which will be coming up next week. Our email is thefinalbar@stockcharts.com. We are on Twitter @finalbarsctv. We're on YouTube, and put a comment below the video that you're watching. We'll gather all those questions and hope to answer you in our next mailbag segment. Also, as a reminder, go to stockchartstv.com, use your email, set up a free account. You can watch all of our fantastic content, including special events like our Chart School series this week on idea generation, The Pitch, which was a fantastic discussion yesterday with Aaron Swenlin, Mary Ellen McGonigal, and Danielle Shea. We had a lot of fun talking about their 15 stock and ETF picks, all of that and much more on StockCharts TV on demand. You can go to that website, or we are on all the app stores. I want to continue on with the final bar mailbag. This is an opportunity to hear from you, answer some of the questions that are coming up in your own analytical process. Let's get to it. Hello, David. I've noticed that the volume for the market has been dropping over the last week, even as markets try to take to new highs. Is this a strong indication of market exhaustion? It's a really, really good question. We've talked a little bit about the volume conditions. I mentioned it a couple of times. And, so I have a couple of thoughts on this, which I'll give you briefly. So first off, is this a strong indication of market exhaustion? Not really. And I would say in general, especially this week, I tend to think of holiday weeks, not that you ignore them, because I don't think you can ever ignore price action, because the markets are still open, things are happening, but volume tends to be lighter, a lot less participants than average. And so as a result, what you can usually not expect are huge moves, except for like earnings and news events and things that would dramatically cause a change in valuations. In general, not a lot of crazy stuff is going to tend to happen in this sort of week. And so I think, in general, I expect flat to positive and lighter volume. So what you should be concerned with is when volume is unexpectedly low, right? When you expect a normal amount of volume and you're seeing less. Now, the essence of your question is it a concern, or should it be a concern that the market rallies on lighter volume? And that's a very good question. I'm going to switch to a different chart because I don't actually usually show volume on my charts. And this is the one that'll show it. So today actually had a lot more volume here. This is month end, so I'm guessing that was probably what was going on here. Let me look at the SPYs. Yeah, see, that might have just been a weird S&P volume here. When I'm looking at the spiders, I'm seeing, this is sort of the lighter volume this week. You can see the red bars and gray bars going back. Other times you've had much heavier volume, and especially during pullbacks, you've tended to have heavier volume conditions here. So in general, yeah, the market moving higher on lesser volume tends to be, in general, more negative than positive, right? And if things are good, you want the market moving higher, you want increasing volume, expanding volume, which signals that broad institutions are accumulating. And that's what would cause price to go higher, and would be the volume going higher, or big institutions accumulating a lot of shares, basically is what that would imply. But there's a lot that can go into volume, and there's a reason why I don't show volume a lot on my charts. I'm not a huge fan of using volume as an indicator, and I used to be. But when I learned technical analysis in the early 2000s, this was just coming out of decimalization. This was just when things like money flow had been very popular in the 80s into the 90s. And a lot of that sort of came out of vogue because a lot of the volume indications became less meaningful because of just the way stocks have changed trading. There's like dark pools and high frequency trading, all of that affects the volume read. So I don't pay as much attention to volume, especially on individual stocks. I wouldn't read too much into the lighter volume right now, just given the holiday week. Next question, this was a wordy one, so I'll summarize it here. There's a chart circulating around recently, an analog chart, which overlaid the S&P chart from March 2020 low to now versus the S&P coming off the 2009 lows and back into 2010. Let's see, and it looks very, very similar. Can we create that sort of analog chart using StockCharts? Really, really good question. So the short answer is no. And I've used a chart to show that relationship. Could I quickly find it for you? I don't know, but I'll try here very quickly. Basically, the chart that I've tended to look at was showing the movement in these in the previous comparing 2009 to 2010, which was the bottom in 2009, the rally in 2010, comparing that to the bottom in 2020 and the rally in 2021. I'm not gonna be able to find it quickly, and I apologize for that. So I basically look at a long-term weekly chart and just overlay some of those key indications on the chart, and I just highlight the two areas, which visually makes it very easy to do it. What you're implying is more of an analog, which is take this data series and overlay another one on it. No, the way people do that with StockCharts is create two different charts and then create an image where you stack the two of them. That's the way I would probably do it. We have talked with the development team about creating a sort of an analog tool, which would allow you to overlay two different time periods very easily and sort of compare the performance. It's not something we have ready for you yet, but I appreciate you asking. Hopefully we can bump it up the queue soon. Next question, I hear lots of talk about cyclical stocks, but nothing about where to look at the list of them or seasonal trends in them. Any info you can provide will be greatly appreciated. You know, it's funny, and I will tell you, as I was learning what I have, especially early in my career, I've often found that in the financial industry, we love to summarize and use quick shortcuts and talk about things like inflation and the Fed and cyclicals and all of that, and even just things like small caps. Most of my first couple of years, I think, was looking up terms that I would hear people use and just trying to make sense of them and trying to understand them and ask. Luckily, I was able to talk with institutional, investors that knew a lot about a lot of those things. But so here's what I would tell you: if you look on StockCharts, we have this really cool sector rotation model. This comes from Sam Stovall. He's been a guest on this show actually a couple times, and it was a pioneer in the field of sector rotation. He's done a really good job. He's now at CFRA Research in New York. To get to this, by the way, if you go to the charts and tools section, you'll see a link for the sector ETF performance chart. Just below that, there's the sector rotation model. What you want to look at is the orange cycle here, which is the market cycle. The blue one, by the way, you can ignore for now. That's the economic cycle. Stocks tend to lead the economy. That's why when you talk about stocks being a leading indicator, this is the fact that the orange curve is before the blue curve is what that means. If you look above here, when you see a market in a bottoming phase, then a bull market phase, then a top, and then a bear market, you can see up here the sectors that tend to do well in each of those different moments. So wherever you think we are on this idealized curve, these are the sectors that tend to do pretty well. When you're talking about cyclicals, you're talking about things like industrials, materials, energy. You think of those as cyclical, economically sensitive, right? So they are very sensitive to changes in the economy. Something like consumer staples, healthcare. If you get sick, you're going to go to the doctor, and that's not a discretionary decision. If you need toilet paper, you're going to go get toilet paper. But certain things, you may not improve your house unless you have the capital to do so, and then you might not travel as much unless the conditions are good for it. And so these are more economically sensitive. They tend to be effective during a bull market phase, and especially later in these materials and energy. When I talk about late cyclicals, that's what we're talking about there. When those are doing well, that tends to be in the later stage of a bull market, and you can see what tends to happen to the market after that. I would spend some more time with that with that visual if you didn't understand what I said there. Final question, and I love this one. What do you feel has been your most difficult lesson, one you have had to relive over and over regarding technical analysis? I make a lot of mistakes, so curious what yours would be. And I appreciate the very thought-provoking question, and it's one I would love to ask anyone I bring on the show. For me, I would say the most difficult lesson is just following what the charts tell you to do. What I have found is, when people are trying to learn technical analysis, I always tell them that analyzing the chart is the easy part. I can teach you how to do that. It's not hard to pick up all of these rules and understand them. Now, obviously, with more experience and learning a lot of mistakes along the way, you can improve your analysis, but that's just understanding the toolkit. I think the bigger challenge for me is the emotional challenge, the challenge of trading, right? Trading is not just analyzing the chart, it's actually putting capital to work and having the intestinal fortitude, as one of my guests put it on the pitch yesterday, to withstand the fact that you're going to be wrong a lot. And on average, you're going to be wrong maybe half the time. If you're really consistently good, maybe 60, 70% of the time you're right, but that still means 30 to 40% of the time you're going to be wrong. And so managing your risk, having lines in the sand and actually sticking to them. How many times has this happened to you where you buy a chart, the chart goes down, you don't sell it, even though you know you should because you talk yourself into holding it? Those are the lessons I struggle to stick with. Those are the things that I find a lot of people learning technical analysis struggle with. I wish you well in that ongoing lifelong journey to minimize those temptations to ignore what the chart is telling you. We need to wrap this show. Go to the 3 and 3 charts in 3 minutes. Here we go. Chart number one is the S&P 500 bullish percent index. During our Wrap the Week segment, we talked about the breadth conditions. And again, as my guest Jeff Hughes mentioned yesterday, overall breadth is very positive. And I completely agree with him. If you're looking for some sign of weakness in breadth, I would struggle to find anything along those lines. In general, it tells you the trends are pretty positive. I'm not seeing anything telling me to be climactically negative. And one of the charts that would keep me optimistic would be the bullish percent index. This remains above 70, which it has over the last couple of weeks. Tells you the conditions are strong and remaining strong. When that breaks below 70 on a pullback, that's where it doesn't guarantee that we're going to go to zero or retest major lows. You can see here earlier in the year, we did it a couple times, but it tells me to put my risk management hat on and focus a little more on potential downside. Chart number two is the gold futures, right? $ GOLD. I see this as a classic rotation from distribution phase to accumulation phase. By the way, if you invert this chart, feels a lot to me like the chart of Bitcoin, which is rotated from accumulation to distribution. But here we had this distribution phase going through the first quarter of the year, starting in March. You had a bottom, a nice double bottom there in March, rotating back higher off the 1700 level and propelling upwards. We've gone above trendline resistance. We've gone above moving averages. I think getting above the last Fibonacci resistance level, getting above the 200-day moving average is super encouraging. If gold does pull back, I think you have really clear support at trend lines from the recent lows and also the 50-day moving average and also the Fibonacci support level. So I have pretty clear risk, and I think you have upside at the least to 1960, if not retesting the previous highs. Overbought though, which I would certainly watch. Finally, this is your standard public service announcement to respect charts that are going higher. Something like real estate is not something you might expect to do well when the market is testing all-time highs, but it has. Real estate and charts like this don't care what you think should work. It is going to do what it does. And this is showing you that investors are accumulating real estate. The relative strength has been pretty consistently strong through the course of 2021. The trend has gone higher with higher highs and higher lows. We're above two upward sloping moving averages. And overall, I think the conditions are good to see this continue to move higher. So thumbs up so far on the trend in real estate. Folks, that is our show for today. And that's a wrap for this week on the Final Bar. Thanks so much for joining us every weekday after the close and following all our comments on the markets. As a reminder, go to StockChartsTV.com to analyze all of our great hosts and guests and all of their ideas going back. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great long weekend. We'll see you next Tuesday.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.